Welcome to the Foundery, where leaders are forged daily. And now your host, George Roberts.
Welcome back, entrepreneurs. Today, we welcome Bradley Kirschbaum, co-principal from Symphony Capital Group. Welcome to the show, Bradley.
Hey, George. Thanks for having me on. I realized last week you had my partner Ellis on a little while back, and you guys had a great podcast as well. So I hope, hopefully we can exceed that one.
I love it. I love the competition. Let's do it. So great group that you've got there. And before I ask you more about your group, let's just get into the story of your life. Tell us about what you've been doing in commercial real estate and what led up to that.
Sure. So Symphony Capital Group has been investing around the Southwest for the next year to year and a half. We'll be focused solely in Dallas, where we've got some good traction. In fact, we're under contract on 200 units over in Allen, Texas, on the east side of Dallas, with a beautiful, beautiful opportunity that will close the first week of July. But we've bought in Albuquerque, Kansas City, Austin, Houston, Dallas, to name pretty much everything we've done so far. And at first, we really formed up at the end of 2019, and COVID basically hit immediately after that. And there was a lot of things to consider, a lot of people changing gears, a lot of unknowns. And in a way, we're kind of exiting COVID and entering an economic version of it, in terms of people switching gears and people rethinking what they're doing and wondering what the future holds when you look at how the Fed's, reacting to controlling the greater economy. So it creates another tumultuous situation for us to grow our company in, but we're looking forward to the challenge. But realistically, George, since I graduated Marquette back in 2012, I immediately joined the Navy and became a helicopter pilot. And I was flying for a few years. And during that whole time, I was investing in one thing or another. I was paying attention to all the kinds of equities, stocks, and real estate was kind of on the back burner. I thought it was kind of the old man's play. I thought it was pretty boring. Just looking at REITs, which might be a good liquid consideration, you're not really making top dollar out of those. And I thought it wasn't quite something I wanted to get into as a young guy who could maybe take more risk, move a little faster. I didn't think about real estate. And then in 2016, I really saw the light and realized that one of the key factors in investing is understanding that the more risk you take, the more yield you want, the more risk you're going to have to take to potentially receive that yield. And within real estate, you get the opportunity to find double-digit yield on quite a few different positions and different ways to make those plays. And at the same time, eliminate the biggest headwind that's holding you back, which is taxes. You can get rid of a huge expense on your yearly passive income by eliminating taxes via a few different methods. And in the end, when you talk about your risk-adjusted gains, being able to pursue that type of investment model where you are, exceeding the general stock market and eliminating your costs to do so, that becomes a winning combination. And so right around 2016, I realized real estate, particularly commercial real estate, was the way to go. And I started pursuing it from my own portfolio, making my own investments. And by 2018, I knew I wanted to set up a syndication business and started finding my partners, which include Ellis Hammond, who is on your pod, as well as Jeremy Cisneros and Keith Meyer. And we've been trucking along ever since.
So exciting story, a lot to dig in. I think that I would love to hear the story of Symphony Capital Group. So tell us that origin story. At this point, you're interested in real estate, maybe not quite ready to start syndication, or maybe you've already decided that. Where are you at in the journey?
So right around 2017, going into 2018, I realized what it took to put together a syndication business. I had invested in just a couple syndications at that point, and I was on a pitch where I was certain that I knew more than the person pitching me. It's as simple as that. And I thought, I'm ready to shift gears. Flying has been fun. I liked serving in the Navy, but I just had that entrepreneurial spirit where I knew I'd get into business some way, somehow, and I wanted to work for myself. And at the end of the day, I thought, well, I'll stack the things I'm interested in. I'm interested in investing. I like paying attention to the markets. I think real estate has performed well for me. And at this point, by the way, I'd bitten off on the fact that real estate was where I wanted to build the bedrock of my wealth, if you will. It's what I wanted to push into the most. And I knew that it was a business model that, as an individual, already almost a decade into a career, I could pivot and start syndicating if I did things the right way. And one of those things that I thought was the right way was to find partners. So right around 2019, I started networking like crazy. I mean, I would get off work and I was at networking events 4 nights a week minimum. And a lot of that was just taking business cards from realtors that allowed the meetups here in San Diego, which is fine. I met some great people, but every once in a while I'd find someone who was doing what I wanted to do and had the same interests. And slowly but surely, I met Ellis. We had a coffee one time, and we didn't speak for a month or so. We didn't really hit it off right off the bat by any means. And then I kind of met Jeremy at another meetup, and then Ellis, and we all just kept seeing each other. And eventually, to some degree, we formed a support group and just started meeting up and talking about. The 4 of us were talking about what we wanted to do, what we were looking at. And after just a couple months, we realized, hey, we cover different bases. We cover different strengths within the business model, within our own knowledge. We could be a formidable team if we started getting some traction together. So we kicked things off and formed Symphony Capital Group. And I guess you could say the rest is history, but it's been a short 3 years. Time goes fast. And now we're, making offers and getting into contract on $50 million deals, which is mind blowing to me. It's pretty wild.
That is amazing. And first, thank you for your service, Bradley.
I had too much fun to be thanked. That's how I like to put that. But thanks. I appreciate that.
That's awesome. And from there, I think that it would be really great to hear, what was it like to be, you're not just a long distance investor at this point. I'm going back a couple of years. I understand you're 1 month out of the Navy now, right? So you fully transitioned into commercial real estate, but yeah. Taking it back to the time frame where you're out, you're deployed, and still you bought, I think it was, did you say $100 million
yes.
of assets? So tell us, what was that like? How did you juggle that? And do you have any advice for other people that may be in a similar situation?
Just hearing you say that is mind blowing. Like, I really don't realize that we're there, but we are. So some of those positions, to be fair, were co-general partnerships where our team was able to lean on another team with great strengths. Kansas City is a great example. While we are focused in Dallas for the next year and a half, we'd like to accumulate 1,000 units there before we try to find traction in other markets. Kansas City is a great example where we just have a single CoGP that we've worked with twice now. We've closed almost 200 units with them, and we'd love to, buy as many properties with them as possible. It's just about synergy. Great people, great experience, great opportunities. We would rinse and repeat that a few more times, and our investors would be happy about it. But so we did lean on other shoulders and have assistance in the CoGP situation. And speaking of leaning on other shoulders, there were times when, I was in the last 15 months, I was gone for nearly 9 months of that, where I was underway. I was over over in the South China Sea or somewhere in the Pacific, and I could only do so much. So my teammates were really pushing the ball as far as possible, right? And I can't do on-site due diligence. I can't do broker calls efficiently because on a military vessel, it's not the Carnival cruise. You have very limited cell phone signal. And I was actually extremely blessed with that last deployment. I was on the USS Carl Vinson, one of our aircraft carriers, and the Navy did an experiment and actually put Wi-Fi in the mess hall where I was eating, as well as the chow hall for the guys. And so I'm one of the only people in the history of the Navy to ever have access to Wi-Fi, but it enabled me. And I would find myself up in the middle of the night at 2, 3, 4 in the morning to get on the phone and talk with people back in the United States, just as if I was still on LinkedIn here networking. And it's funny because in the last 3 days, we're on the hunt for some capital because we need to raise about 17 million for our current deal. And I was calling and talking with individuals that had no idea that I was talking to them at 3 in the morning local. And now those relationships are coming to fruition where they're going to be participating. They're bringing other investors. In fact, a few of those folks are, brands, if you will. They promote investing via saying, they're a physician who invests or whatever the case is, right? And a couple of those brands are going to work with us in terms of capital raising now. And while the guys put forth a lot of effort here in the States that push us forward as much as possible, I'm glad I had the discipline to wake up and make it happen. And now I'm getting to see a few of those things become fruitful, half a year, 12 months later. So that's how I was participating. That's how I was keeping things moving along from the other side of the world. But at the end of the day, it just comes out down to no one else is going to get things done. If you want to go from buying duplexes and triplexes to buying 200 unit deals or 351 unit deals, you just have to get up and do what you can for the team and do the work.
So what I'm hearing is that if you're willing to put yourself out there and network, and if you've still got some boots on the ground, you can do it really from just about anywhere.
Absolutely. There's some great podcasts out there. Marcus Long, I'll give a shout out to him. He's a lieutenant commander in the Navy. He's stationed in England right now, and he's been buying properties across the United States as well. And if I understand Marcus correctly, he doesn't quite have the same team that I do in the United States. And he's just another great example of people who are really just putting in the work and not making up any excuses. I mean, the world is so remote now. Look at you and I are connecting from California to Michigan, right? And for what? So that we can both talk about our cause and what we're doing and find publicity with that, and just tell people that, hey, this is what we do. This is what we focus on. And we're determined enough to make it happen. That's why you and I are both here today, right?
Yeah.
But that's what it all really comes down to.
Yeah. If you get the determination, you can make anything happen.
Absolutely.
Now, you mentioned many markets, including some more towards, say, the Midwest. Can you tell us why you picked some of your favorite markets?
So right now, our favorite is definitely Texas, and staying focused on Texas. And I'll tell you why. And it comes back to what we spoke about earlier, which is rates. Rates are changing. And when rates change and go up, it makes the entire deal more expensive. More of your cash flow is going to have to cover your debt expense, right? So the other, we'll call it threat, is logistics. Because of COVID and because of the state of the world right now, Shanghai is still being on lockdown at this time of recording. A lot of things aren't coming in quickly. It's taking months to get a washer and dryer. It's taking a lot more dollars just to buy lumber, right? And so that has made the quintessential Class C forced renovation play a little more risky in our mindset. We're a little less willing to say, hey, we're going to knock out this renovation on 150 Class C units and bring it up to a B minus B class asset in the next 2 years. And that threat is there simply because of the supply chain logistics. It might take longer than that. It might take a lot more dollars to hire all those contractors and get all that flooring in, get the painting done. So we're backing away from that threat a little bit, where 2 years ago, we found great deals in Kansas City. And those deals are coming to fruition and trucking along just fine. We're above pace, and financially they're doing better than we thought. But we preemptively bought lots and lots of washers and dryers the second there was an inkling that there could be logistics problems. We have a lot of supplies from the first property that are being brought over to the second property, and it's going to be a rinse and repeat situation. We have multiple units that are just filled with gear for the contractors to use. And because we have that supplies, we know we can keep up a good clip and continue on while we wait for additional supplies to come in. But what we've done is pivot away from some of the C plus stuff, and we're looking into the B plus, A minus material that is really going to let us cover these loss to lease situations, which is to say they're large, stabilized, quality units that are always going to have high demand from the environment, from all these new tenants who are moving to Dallas, moving to these major hubs in Texas. And they're already 95+% occupied, but a lot of the leases are lower than what the market rate is, and substantially. Things are changing in Texas so quickly that we have multiple units that are $200 below market, and those individuals had actually leased up within the last 12 months. So the loss to lease play that we're going to be covering is a much less risky scenario, at least in terms of being able to control the time frame. It's a lot more simple to already have a stabilized asset with fixed debt. And I'll get into the debt situation because we were talking about rates. But taking that stabilized asset, it does need a little bit of renovation. About a quarter of the units need to be done, but it's much less threatening than overturning the entire property, right? So we get some forced appreciation in there to a less threatening degree than renovating an entire property. And we have one of the prettiest properties in the entire municipality, bar nothing. We're looking at the other properties around us, the other comps, and we will be asking for a lower rent rate than them, even though we are certain that the amenities and the quality of our property are going to be as good, if not better, than the comps. And in that case, we've got a great play for bringing more tenants into our property. But getting into the debt and that debt expense, it's an interesting environment right now, but you can lock in both fixed debt or at least a rate cap. So we are buying a rate cap on this, which, to summarize in 10 seconds, means we have a loan that is starting at a particular rate. The rate can adjust, but we have basically bought insurance on how high that rate can go. It costs us to do so. It's actually fairly expensive to do that, but it solidifies our expenses for the next 3 to 5 years, however long the business model is executed, right? However long you want to fix in that debt on your particular property. And by fixing in that expense, it eliminates the threat of a floating rate that makes its way to 7 or 8% or something on us. And now it's sucking up all our cash flow and we don't have money to continue to execute the business plan. So that's a simple way of helping to eliminate that threat, is just to kind of pay the expense up front, basically lock in the insurance, ensure you aren't going to have a situation that gets out of control, and not seek to maximize your returns in some sense. We could sit here and not pay the expense and say, it'll be okay. But in this environment, we're just not willing to do that. So we'll take the conservative route.
Yeah, great approach to mitigate the downside. I think there's a lot of lessons there for people who are listening, particularly people looking at how to navigate the current situation. What I'm hearing is that you're moving from the renovation play of days gone by to the operations play. I think that I've seen a lot of that lately for many reasons, not just the supply chain, but also it's the A and B assets that have been performing. When you look at the people or the rates or the rents that have been charged recently, most of the increases have been in the A and B. And my personal take on that is that you've got a lot of people who would have been homeowners. Maybe they have to move. The rates have gone up. What you can afford on that same salary now, all of a sudden, is a lot smaller. And maybe it no longer looks enticing to be a homeowner. And so these people become tenants, but they don't want to go and rent junk. So they end up renting something that's high quality, something that looks like the sort of home that they would live in. They end up becoming A and B class tenants.
We're absolutely capturing that market. That's what we're looking for. And let's play devil's advocate here. Let's say things get worse. Let's say an economic asteroid hits the United States. I want to own the asset that for the next 20 years is going to continue to attract quality tenants. I don't want to fight some uphill battle for 5, 10, 15 years trying to keep cash flow positive on a crummy property that we have to lure people to. I want the prettiest property that everyone who's considering renting is going to consider. I want everyone to be saying, hey, this place has great amenities. The dog loves it. The kids love it. We're paying a little premium for some of the quality of life things we want here, but the location's great. I get to my work within 20 minutes and I could stay here for quite a while we figure out how we do buy that house, while we wait for rates to stabilize, while we wait for the economy to do better. And let's say people are, worst case situation, losing jobs, right? You want the property that people who are backing out of homes default back to. You want the property that people who are doing okay jump up into, right? You want to look desirable to everyone, regardless of what the general economics of your municipality that you're buying into are doing. So that's the type of property we want to stay focused on for the next couple of years.
Great. And the other side of the coin is affordability. So on the one hand, I see the A and B class performing, and I have this tendency to want to move in that direction. But as you mentioned, you have to play the devil's advocate, and we have to ask the question, well, at what point has that race run its course? And at what point do people start looking for things that are more affordable? So do you have any strategies that you're employing to handle that?
Yeah, so you can actually measure this, George, and I think it's some of the data that, if you're not already getting into this yourself as a data scientist, is that right?
That's right, my former life.
We break this down. One of the easy things to look at is, what is the household income in your neighborhood, and what's the household income for your city that you're buying into? And you can roughly estimate that 33% of someone's income is going to become a hard ceiling for them to rent. In fact, you don't want to rent to someone who needs to pay out a third or more of their income. And right now we've got a great margin, a great delta between what this area's household income is and theoretically what kind of rent rate that household could be buying into. So I'll break this down. Right now on our rents, the property currently has a large portion of the rents that are $150 to $200 below the market comps in the area. And again, I'm talking about our current deal over in Allen. But right now the property is asking for less than the properties around it. It has become and is becoming a better quality property than those asking for more. We will not ask for the same rate or more than our neighbors, continuing to be on a value scale more attractive than our neighbors. And we look at the general neighborhood of the population around us who might decide to rent, aside from just looking at the value, aside from just seeing what we're like compared to our neighbors, when they look at what they can afford within their checkbook, we're shooting at roughly a 24 to 26% of a $110,000 household income, which is the average for our local area, which is within a good margin of that theoretical 33% threshold. So we're backing down from that 1/3 of your paycheck situation. We've got a good delta there, which keeps things attractive. And in all circumstances considered situation, it probably means rents are going to keep running up in the next 3 to 5 years because there is that capability for people to pay more, and there are not more units coming to market. In fact, very specifically, you basically can't build a garden style apartment complex in the area that we're buying. The land that is still zoned for it is so small that you really couldn't get it done. And the land that currently has properties on it can't be rebuilt. So we have a property that just is not being built, and developers aren't building it because we're buying at and below the build price. I mean, that's something that people in the United States who aren't paying attention don't quite grasp, is that while things might be getting more expensive, it's becoming much more expensive to build. So if you can't develop units at a lower price point per unit than what I can buy them for, you're not going to build them. And that's a huge supply demand issue that the United States needs to work out. And I think, I'm getting theoretical here, but I think we're going to see some major tax incentives, maybe a large program federally to incentivize developers to start pushing out many, many more units across the United States. There's too large of a deficit, and we can only take that kind of crunch for so long.
Fabulous stuff. So you focus a lot on the income margin, and I think that's a great way to go. Something I've been looking at a lot, particularly for my most recent properties. Another thing that I've been looking at, and I wonder if you've been looking at as well, is which markets you're in, because certain markets, it seems, are a little bit overbought. And again, whether or not you agree with that depends on issues like building, right? Can you build at a cheaper rate? If you can do that, then you could get outbuilt. If not, then it's a little bit more difficult. But has it in any way impacted the markets that you're looking at?
I'll put it this way. I'm not interested in buying a single family house anytime in the future in terms of an investment, right? Mm-hmm. But I have a neighbor who's in a financial situation where he would find it very compelling for me to buy his house for basically a third of the price. I'd give him a third of the market value. I'd give him a third of the market value, all cash, and then let him live there rent free for the rest of his life. He's in a situation where he needs money. I can help him out, and I can be helped out in the same case, right? Even if I don't like the market of San Diego, which is what I'm talking about right now, even if I don't like single family, when I'm in a position to buy something at a third of the price that it actually costs, I'm going to do it. You could tell me the entire market's overblown, but when I find a deal like that, I'm buying it. So going back to Dallas to get into a more refined situation, the entire market is expensive as heck for tenants, for investors, without a doubt. Dallas added 100,000 people to its population. They went from 1.2 to 1.3 million people from July of 2020 until July of 2021. The stop button has not been hit. People are still walking, running, driving, flying to Dallas and Texas as a whole, and they don't know where to live. There's just nowhere to live. I was on a flight from Chicago to Austin, which is not Dallas, but it is Texas. I was on a flight from Chicago to Austin. I was in the airport, unfortunately, for 5 or 6 hours, which was pretty boring. But as I walked around and listened to some podcasts, including yours, because I had to catch up on that.
I appreciate that.
There you go. But I was walking around listening to podcasts, and it became very apparent when my gate lined up to go to Austin that we were the youngest population of all the gates that I had looked at that day. Hundreds of people, average age had to have been less than 30. I was astonished because I had not seen that at any gate throughout my life, nor had I ever thought to look for it. But it looked like we were all lining up to go to our master's or a grad degree or something like that. I mean, truly, that's what's moving to Texas. You've got huge tech jobs moving into Austin. You've got large industrial jobs. You've got large AWS centers all over the state. It is like a funnel right now. It's insane. And I remember people 10 years ago saying, Texas is really attractive, no income taxes, good weather, pretty cheap housing. And now we're seeing it 10 years later, people are just funneling in. And that's really the story in Dallas. We're buying below our comps. We're raising rents below our comps. And we've got a huge siphon of people who are continuing to move to our suburb of Dallas because it's beautiful. It's got the best schools. It is the most desirable, it's the crown gem. It is literally the gem in the crown that everyone looks at and will consider. And with that kind of rental purchasing pressure, we're going to continue to see rents skyrocket, whether someone wants to say you're overpaying or not. I think it behooves you to buy today and wait for tomorrow.
Okay, I love it. And what you were speaking to at the outset there is really what might be called a special situation. So you're focused on multifamily, but hey, if you can buy something at a third of the value, obviously there's some time value of money. You're going to wait to be able to cash in on the investment, but that makes a lot of sense. I love people that have their eyes open for other things, even as you're focusing on the big thing.
Right. And, when I was getting started, what comes to you is going to be whatever you focus on, right? If you focus on something, that is what you'll move towards. It's what you'll gravitate towards, and it will gravitate towards you. But I'm not going to deny a good deal when one comes my way, right? But it's a good analogy. With people would say San Diego's red hot, and it is. Things are going for 10, 15, 20% over listing price.
Right.
And plenty of people right now would say, don't buy San Diego. Oh, the tenant laws are horrible. Actually, I would like my tenant to live there for free if I can buy into that deal. So
right.
I don't know, kind of contrarian, I suppose, but it also makes a lot of sense.
Yes. Well, you can do anything you want to if you have a margin of safety. Sounds like that's right. The sort of deal you're describing. Well, a couple of things that I wanted to pick up on. First of all, I promised that I'd give you the opportunity to tell us about how your naval career translated into commercial real estate. Is there anything you want to add there?
I was reflecting on this last month. I only just got out of the Navy within the last month or so. And there really is a few direct parallels. One of them being handling other people's money. I wouldn't have thought that I was in the financial game while I was in the Navy, but it really was. We talk about it all the time. We're a steward of the taxpayers. Yeah. The assets we have, the supplies we have, they are not ours. They are paid for by the federal government, which is, working on behalf of the taxpayers themselves. And that is why we have aircraft that are 60 years old. They're not just old. We're making them run for as long as we can. And you do that by changing the oil, paying attention to what the needs are, fixing things and maintaining things to a T. Not just for safety, but for the fact that you need them to run the distance and work for as long as you can, right? Our helicopters, I was fortunate to fly and work on something that's relatively brand new. It's about 10, 15 years old now. When you look at the entire fleet of helicopters that I was flying, and I was fortunate. I got to play with some new toys that were pretty sweet, but they weren't mine. They were other people's. And within real estate, I get to do some pretty sweet things. We're buying hundreds of units at a time. That's something I couldn't have even imagined 5 years ago, but I'm well aware that I'm using other people's capital to do so. And we are in tune to the fact that it's not ours, and we need to do right by everyone who puts their faith and trust in us. And it's just an important aspect to not forget. We might be buying big, we might be going big and going after large deals, but it's only possible because we're empowered by the people who have decided, hey, we're doing the right thing and we're going to make the right decisions. So we owe, right? We owe other people who have put their faith and trust in us. And that's how we act, and that's how we're going to perform.
Beautifully put. And if I was just to summarize that, when you're in finance, it's all about integrity. And that's one of the things that you had the opportunity to build in your career. And if that's a sort of person that you see yourself in, now speaking directly to the audience, I don't know where you're at in your financial life, but if you're the sort of person that feels that they can take care of other people's money, that you have integrity, and that you can project that in such a way that others trust you, then this could be a great career for you.
Yeah, absolutely. The other parallel that comes to mind, slightly different topic here, but there is a systematic routine. There is a checklist for everything military. It's much less creative than you might think. People aren't exactly whipping around the skies and flying where they want and doing barrel rolls all the time. There's a checklist. There's a format. There's a brief. There's a preemptive game plan of how things should go. Of course, there's reasons why you're going to have to flex and make changes on the fly. But it's very much the same way we operate buying these buildings. We figure out what the game plan would be, and then we buy, and you actually have to execute. At some point, you actually have the asset. You actually have to make it work. And what you had on paper doesn't matter, but there's still a system. There's still an outline to follow. And those things have also coincided fairly well with how our team operates and how we look at expanding in the future. So it's just another parallel to how things are done in two very different environments.
Awesome. I want to hit one other thing that you mentioned. You've loved the role of being a CoGP, and I think that's huge. A lot of people may be at the stage where they may or may not have their first apartment. If they have their first apartment, maybe they haven't done a syndication. Being a CoGP is a huge step. That can be an awesome gateway to becoming a GP. Another thing that I've heard about co-GPing is it's a great way to try a different type of deal. So if you're used to doing certain deals, like maybe you do stabilized assets and you wanted to try a value add, it's a great way to branch out. So do you have any particular hints, tips, or tricks, anything you'd like to tell our audience for somebody who is hoping to get into that co-GP role or would like to find more such roles?
Two things come to the top of my mind. The first is figure out how you're going to convince the other GP, who I'm going to guess is more experienced with whatever the asset is or whatever the level of business is. Figure out what that piece of value is that you can bring to them and then get better at it. Just continue to focus on that, learn about it, build your brand, whatever it is. And the other piece here is to take your time. Don't rush into a partnership because business is sticky. And once you start sticking to things, it's hard to get unstuck. It's a lot easier in some sense to say, hey, we have synergy. We could do something together. But if you say that within the first 20 minutes of meeting someone and 60 minutes later, you've already signed the LLC paperwork and now you're formed up and you've got a business, it's a long road. You've got days and years ahead of you. And you really want to make sure that the people you're working with are going to operate in the way that you're going to operate and the way you thought they would operate. And I would take your time finding those synergies. And something that on point number one, I don't think I articulated this well. And so I'll make a specific example. A few people have reached out to me in the last 3-4 months saying, hey, I'm just getting going. How can I provide value to people? And a couple of those 3 individuals I'm thinking of right now are running podcasts and they are doing publicity. I've had discussions with them saying, look, you could get going right now in one of the hottest markets ever. You could pair up with some people, bring value to them, get your first deals done, and that'd be great. If I was you, or if I was to backtrack about 5 years, I would probably just keep learning. I would probably, in this environment today, I would probably level myself up so that I wasn't, let's say, a beggar, because beggars can't be choosers. And I'm afraid that if I'm not bringing enough value to the person that I'm seeking out working with, I might not get myself into the best position or the best partnership possible. So simple things people can do is publicity, podcasts, right? You're bringing a ton of value to a lot of other people who have been doing this for 3, 4, 5, 10 years. And that in and of itself is going to be seen as valuable. And at worst, you're going to sit on an hour-long call and learn a lot, right? you're going to have access to people where when you show up to that conference, let's Bigger Pockets, best ever, whatever it is, a lot of people are going to know you, and you're not going to be standing in the corner wondering how you can go from zero to hero. You're actually going to have a lot of contacts, and you're going to get to go to dinner, and you're going to be at the lunches, and you're going to have more conversations, and you'll get to meet a lot more people who are actually doing the things you want to do. Because when you're starting out, there are so many people who just want to chat. You might have some synergy. You might both be in real estate, but they're not really the right person for you. A lot of people want to get coffee. A lot of people want to have, a 20-minute Zoom and see if we can work together. But if you were to walk into one of those conferences with a lot of people in the industry knowing who you are, a lot of people having already paid attention to you, having seen you go from, interviewing friends and family to interviewing big names, they're going to say, hey, this person's putting forth a lot of effort. This person has some contacts. Let me figure out what's going on here. And you're going to get into stronger partnerships than you would have had you just rushed into something. So take your time, build your value, however that might be done, and learn as much as you can, and just don't be in a rush. You have to go quickly, but you don't want to trip over yourself. Does that make sense?
That makes so much sense. And I just want to say that I appreciate, not only because I think that's great advice to first focus on your value proposition, and second, don't rush it. It's something very important. I like to liken it to a marriage, and it's not something you would rush into. This is kind of like a 3 or a 4 or a 5-way marriage. These deals are really big, and you're going to be working with these people for a long time. A lot of gurus, they like to tell you, hey, just do your first deal. You got to do that first deal. Just jump into it. And I think that in many ways, that's kind of self-serving. If you're trying to sell courses, you have to tell everybody that anyone can do it. And you're telling people to just take it slow. Make sure that you know what you're doing before you take that first big step.
Yeah, I think it does frighten me a little bit when people say, just jump in, right?
Yeah.
I think it's fair to say just jump in if it's an internal deal that you're doing yourself. You're buying a duplex or triplex. I assume that's more or less in the realm of an individual who's just getting started.
Right.
Heck yeah, jump in, because you're only going to learn by doing it. When it comes to teammates and working with other people, like I said, it can only get stickier. When you're working on your own, you're only going to learn by getting hands-on. I've only learned the things I've learned. I withdrew the list of required reading from Marquette University, where I graduated, for everyone who was pursuing a degree in real estate. I took that list, took all the books that I thought were relevant, and I rented, bought, or got the PDFs of them and started reading them. This is years ago, but I just was learning as much as possible. And you know what? The first piece of real estate I ever touched, I learned about 5 times as much by doing that. So yes, just jump in, just get the deal done. But when it comes to teammates, take your time.
Love it. Love it. Yeah. So starting in the small or the medium size is a great way to go. Love that advice. Well, I want to say some of my favorite interviews are the ones where I just sort of, throw away the script. And I don't think I asked you more than 1 or 2 of the questions that I commonly ask. So that was perfect. I got to say, I love that. But I feel like we have to wrap it up because people have busy lives. And I think it's a good thing to get into the lightning round. So Bradley, are you ready?
Let's do it.
All right, lightning round. Tell us something about your real estate markets that most people wouldn't know.
100,000 people moved into my market in 1 year.
This is Dallas?
This is Dallas. 100,000 people moved there. Probably larger than the size of the town than most people grew up in. An entire town moved into my town and they don't know where to live. Just absorb that, love it, embrace it. You want to buy in Dallas.
Perfect. That was definitely bigger than the town I grew up in. So 100%. Okay. How about giving us some advice that you would give your younger self?
Ooh, get started earlier. That's kind of vague, but realistically, it takes a long time to get things moving. And I also did not embrace that a little bit every day goes a long way. I figured I had to be 100% focused. I had to be paying attention to doing one thing. If you spent 30 minutes doing anything every day, you'd get really good at it. It doesn't matter what you're talking about. So a little bit every day goes a long way. I highly encourage you to start today.
I love that consistency. So what is some of the best real estate advice you've ever received?
Buy right.
Buy right. I love it.
People say it a lot, but buy right. That's all that matters.
100%. That can make up for a multitude of other errors. All right, so this is what I want to do. I want to switch it up a little bit. I've got these cards. These cards have some completely random questions, probably has nothing to do with real estate, but we're going to get to know Bradley a little bit better. So just tell me when to stop cutting the deck.
That's good.
All right, top question. What remains undone that you have wanted to get done for years?
Ooh, well, I would like to hike the tallest peaks in the world. There are 7 peaks that are considered the tallest. I'd like to go down to Argentina and knock out Mount Aconcagua, which is the largest down in South America. And I'm trying to pursue that next. So I got a couple mountains to conquer.
Beautiful. All right. So now let's move back to the realm of advice. What is the worst real estate advice that you've heard going around, or give us a misstep that you see people making that you'd like to help people avoid?
Yeah, the biggest misstep is pursuing the shiny objects. When you're just starting out, you start focusing on one thing or another, and you realize how they're all attached, and you start thinking about how, well, if I'm running this business model, I can also make money doing this, and I can make money doing that, because it's all tied together in some shape or form. People find themselves trying to make money hand over fist, doing multiple different things. Focus on one thing. I don't care if it's wholesaling, buying single families, buying large multifamilies, being a loan underwriter, whatever it is. Focus on one thing, become known for that one thing, and other opportunities, even when you stop looking for them, other opportunities will come into your inbox or whatnot. Continue to put your time into the thing that builds your brand, because your brand is your value. What people think you do is what they will ask you to do. Continue to pursue that.
Awesome. Name a book that's helped to forge you as a leader and as an entrepreneur, and why?
Ooh, both a leader and an entrepreneur. Honestly, Extreme Ownership by Jocko has been one of my favorites in the last 2 or 3 years. It's one of those eliminate your excuses type of books. And the less excuses you make up for things, the more likely you are to pursue the things you really want to do. I can't get enough Jocko right now, so I'm gonna put one out for him and say Extreme Ownership by Jocko Willink.
All right, amazing, a fabulous author. All right, how about one more curveball here? Can you tell us how a failure has set you up for future success?
Ooh, I had some debt issues on the first property I ever bought. In fact, I wouldn't have made it had I not had some strength in my personal network that was able to come in and scoop me out of some troubled times. This was happening right before, it ended up becoming a problem right before the COVID crunch, and no one was issuing debt. I mean, the debt just shriveled up and went away. And it was scary. And it made me think about a few things. One of those being that timeline matters, right? And I was flipping a house basically on a very short timeline. So you're subject to getting things done within that timeline when you look at your expenses, what your expectations of return are. And it made me think twice about whether I ever pursue flipping again, whether I ever pursue flipping a stock, something that's just skyrocketing, right? And let me throw a number out there. I know it's quick round, but here's some numbers. I believe I'm going to get this right. But if you were to hold the S&P 500 from the beginning of its inception to today, if you held it for one day, you have a 61% chance of being profitable. If you held it for 5 business days, you have a 64% chance of being profitable. If you held it for a quarter, you have a 67% chance of being profitable. And if you held it for a year, you have a 71% chance of being profitable. I believe I got those numbers right, but the trend there is the longer you hold, the more likely you are to be profitable. And with real estate, time heals all wounds. So I'm really done at trying to make a quick buck, which is usually not nearly as quick as people think it is. And I want to do things on long established timelines where multiple factors can continue to push my investment towards profitability.
Love it. And I'll add one on since we're being completely spontaneous. I believe that if you hold for 10 years, that you have 100% likelihood of being profitable, measuring from the Great Depression.
Nice. That's a good add-on.
Love it. All right. So let's set us out with your favorite success-oriented quote.
Ooh. Right now, I just read this again a couple days ago, but great leaders realize they serve their team. mediocre leaders think their team serves them. That's something I witnessed many times within the military. It's something I see within real estate. I see it just within how people treat each other within business. You have to realize that while you think you might be in the position of authority, you might think you're the leader, you think you might be the shot caller. None of that is happening without the people around you. And if you are not treating them right, you will lose them very, very quickly. And you'll lose that feeling of being in power. That can evaporate very, very rapidly.
Beautiful, Bradley. Thank you so much for coming to our virtual studio today. A lot of amazing insights. And I really hope that our listeners have the opportunity to get to know more about you. If they want to know more about Bradley Kirschbaum, how can we contact you?
Yeah, of course. Well, if you're watching, I think I've got some info listed right here. It's symphonycapitalgroup.com, and I'm Bradley at symphonycapitalgroup.com. I'd love to talk with anybody who's interested in what we're doing. And if you want to see our next deal in Dallas, go ahead and visit our website and see what we're all about.
All right. Thank you so much.
Hey, thanks, George.